Hello and welcome to a comprehensive problem in ratio analysis which involves preparing and reviewing the DuPont chart based on a company's financials for a period of 4 years. We are going to construct and review a DuPont chart depicting the financial performance of Hotel and Allied Trades Company Limited, a company in the hotel industry. The DuPont chart is a single window presentation of the financials of a business. What happens in the case of a company in its operations, in its profits and in its capital employed are depicted in the form of a few ratios which are linked together in the DuPont chart. It gives the key figures that show how the business has performed at two distinct levels, operations and finance. The two major levels, therefore, in a DuPont analysis are to carve out and study the operating performance ratios and the financial performance ratios. And within the operating performance ratios, there are three sub-levels at which the analysis is further done. These are the capital turnover ratio, which is the sales revenue generated per rupee of capital employed, and then the contribution to sales ratio, which is the variable profit on each rupee of sales revenue, and finally the margin of safety, which is the operating profit per rupee of contribution. As you all know, we have two sets of costs in the business of any company, which is the variable costs and the fixed costs, and contribution analysis and margin of safety helps us to find out what is the level at which the profits are in these two levels. Within the financial performance ratios also, there are two sub-levels. We have financial operations ratio and financial leveraging ratio. The financial operation ratio is the net profit after tax per rupee of operating profit. The operating profit does not straightaway walk into the bottom line. There are a few deductions and additions to that before we reach the profit after tax. Similarly, the financial leveraging ratio is the total capital employed per rupee of shareholder equity. A company finances its business from two distinct kinds of finance: debt finance, which is borrowed from outside, and equity, which is brought in from inside. We will now pick out from the profit and loss account and the balance sheet of the company the base figures required for computing the above ratios. To recap, there are 5 ratios which you have to compute, and all these ratios will be computed using the figures from the financials of the company. Let us first look at the profit and loss account of Hotel and Allied Trades for the 4 years 2010 to 2013. As you can see here, the company had excellent performance in 2010 with sales of 1,45,642 and profits of 14,304 rupees carried to the balance sheet. But from that year, there has been a major reverse in 2011 and 2012, where the company suffered a fall in sales and also therefore a fall in profits. In 2011, the sales went up marginally, but the costs rose substantially, as a result of which the net profit slumped to just 1,162. The company did good sales turnover in the year 2012, but had a setback again in 2013. So you can see here a company whose performance has been witnessing a steady amount of downfall through the 4 years 2010 to 2013. Now we look at the company's balance sheet. First, it can be seen that the company's long-term or fixed assets have gone up from 147,000 to 183,000 in the 3-year period, which means the company has invested rupees 0.36 lakh in long-term assets or fixed assets. Next, we also see that the shareholder equity has gone up from 87,705 to 1,24,871 at the end of 2013. This shows an increase of 37,166 during the period. Of this increase, the major chunk is from equity issue. The share capital of the company, which was 2,500 rupees, went up to 32,500 rupees in the year 2012, which means there was an issue of 30,000 rupees of shares. The other increase is in the profit that has been made by the company during this period and retained without being declared as a dividend. That, as you can see here, has gone up from 85,000 rupees to 92,000 rupees. Now, the 5 or 6 numbers that we require for calculating the DuPont chart ratios are sales volume, capital employed, contribution, operating profit, net profit, and shareholders' equity. You can see that the shareholders' equity is the money that has been invested by the shareholders, whereas capital employed is the money that has been invested in the business either from shareholders or from debt. This is a subtle distinction which we will understand later when we talk about interpreting the DuPont chart. Now first, sales volume can be straightaway picked up from the first row of the profit and loss account. The capital employed is a combination of 3 factors. We have the shareholders' equity and the long-term loans taken by the company and the short-term borrowings which are a part of the current liabilities. When you add these 3, you can get the capital employed. Contribution is the sales volume minus variable costs. You can see from the P&L account that the variable costs are food and beverages consumed and variable staff cost and variable operating expenses. The total of these 3 items will give us the total variable cost, and when we reduce this from the sales volume, we get the contribution. Operating profit is the same as EBIT or earnings before interest and tax, and which again can be picked up from the P&L account. The net profit again is a direct figure from the P&L account, which is the profit after tax. Shareholders' equity we have already worked out when we did capital employed, which is the first line item among the 3 items in capital employed. Now therefore, with this we can straight away work out all the 6 numbers that are required for the working out of the DuPont ratios for each of the 4 years, 2010 to 2013. Now we start working out the ratios. The first ratio among the DuPont chart ratios is the capital turnover ratio, which is the sales volume per rupee of capital employed. To just give you an idea of how the working is done, let us take the year 2010. In the year 2010, the sales volume was 1,45,642 and the capital employed was 1,62,408. Now, the capital turnover ratio is 1,45,642 divided by 1,62,408, which we will now put down here as 0.90. Next, we talk about contribution to sales, which is the contribution, which is 99,394 divided by the sales volume, which is 1,45,642, and that figure works out to 68.2%. Thirdly, we have margin of safety, which is operating profit divided by contribution. Operating profit is 27,202 divided by contribution, which is 99,394, and that comes to 27.4% for the year 2010. Fourthly, we take net profit divided by operating profit, which is the financial operations ratio. The net profit figure for the year 2010 was 15,304 and the operating profit was 27,202, and therefore the financial operation ratio or the net profit divided by operating profit works out to 15,304 divided by 27,202, which is 56.3%. Lastly, we have the leveraging ratio, which is capital employed divided by shareholders' equity. The capital employed figure for the company as a whole was 1,62,408, and we divide this by the shareholders' equity, which is 87,705, and to get a figure of 1.85, which is the financial leveraging ratio. This ratio helps us to find out of the total capital employed, what was the part played by shareholders' equity and what was the part played by debt capital. Now, we can work out the ratios for the next 4 years in the same way, and we now have in front of us all the ratios for all the 4 years. You have the operating performance, which is described to you in 3 ratios, which are capital turnover ratio, contribution to sales ratio, and margin of safety. Looking at each ratio one by one, we see that the capital turnover ratio has gone down steadily from 0.90 to 0.80 and then has moved up a little bit to settle down at 0.81 at the end of 2013. The contribution to sales ratio has fallen sharply through the 4 years to run down from 68.2% to 63.2% by the end of the 4th year. Margin of safety, which is operating profit divided by contribution, has also been adverse or unfavorable. In 2010, the company could get 27.4% of its contribution into its operating profit, whereas this figure has come down to 18.6% in 2011 and then has gone up to 20.4% in 2012 to fall again to 15.6% in 2013. This shows very clearly that the company's operating costs have been going up sharper than the company's improvement in the contribution. The product of these 3 ratios, that is capital turnover ratio, contribution to sales ratio, and the margin of safety, gives us a single ratio of the operating performance, which is the operating performance ratio of the company. This ratio, that is operating profit to capital employed, has slumped from 16.7% in 2010 to 8% in 2013. What we are seeing here from the financials of Hotel and Allied Trades is that the company has been able to generate an operating profit of only 8 rupees per 100 rupees of capital employed in 2013 compared to more than double this number of 16.7 rupees per 100 rupees in the year 2010. So operations wise, we can say that Hotel and Allied Trades have not been very successful during this period. We now come to the financial operations ratios and the financial leveraging ratios, which will tell us about the financial performance of this company. How has this company done in respect of its financial decisions? First, we take the financial operations ratio, which shows the net profit as a percentage of operating profit. This figure was 56.3% in 2010 and moved down to 17.8% by the end of the 3rd year, that is 2013. Actually, the figure crashed to as low as 6.5% in 2011 and then has marginally improved in the next 2 years. Big hit in 2011 because of high interest costs. There was a lot of borrowing in the year 2011, which has impacted the company's financial performance. We next come to the last of the DuPont ratios, which is the financial leveraging ratio. This expresses the total capital employed as a ratio of the shareholders' equity. From 1.85 in the year 2010, the ratio moved up to 2.09 in 2011, which showed that the company had improved its debt in comparison with its equity. Thereafter, the debt has been paid back and therefore the debt equity mix has been more favorable for equity and less for debt. And therefore, the capital employed as a ratio of shareholders' equity has come down to 1.64 and further to 1.56 by the end of 2013. The product of the 2 ratios, that is financial operations ratio and a financial leveraging ratio, it is called a financial performance ratio, is a multiplier of the operating profit on capital employed to arrive at the net profit on shareholders' equity. This is probably the most important aspect of the ratio analysis of a company. That is, a company has to judge its performance at two very distinct levels. How much profit is generated per rupee of capital employed, number one, which is an economic factor, and how much money does the person who has invested money in the company, that is the shareholder, get by way of return, which is a financial metric. Now, when we look at this ratio, a multiplier, it was 1.04 in the year 2010 and has come down to 0.28 by the year 2013. The financial performance had actually gone down to 0.14 in 2011, but thereafter has improved to 0.28, which shows that while financially the company had suffered quite a bit in the year 2011, it has come back to a certain amount of normalcy, but then it is nowhere near the kind of financial performance ratio it was able to achieve in the year 2010. What we see here is a company in its underperforming years. Now, especially for a company which is going through a bad phase, a DuPont analysis is of tremendous value, because not only do these 5 ratios by themselves give the company an indication of where action has to be taken, but in addition, there can be a further breakdown of these ratios into their individual values. For example, when we talk about capital employed, we can break it up between current assets, that is working capital, and fixed assets, which is fixed capital. Similarly, when it comes to operating expenses, we can break it up further between selling and administration, research and development, and production. Now, these are the ways in which the company can further break up the workings to find out where the action lies to improve the company's performance.